Hey CPA candidates, thanks for checking out this video where we're going to walk through everything you need to know about discontinued operations. So before we dive into this video, please subscribe to our YouTube channel. If you're currently studying, join our Facebook groups and Reddit community. And if you haven't yet tried the Universal course, start a free trial today. The links for all of those are in the description of this video. So are we ready to get started? Let's go. One important aspect of a company's income statement that we must be familiar with is discontinued operations. Now, as we can see, discontinued operations, it's part of net income, but it's below income from continuing operations. And basically what we're doing is we're separating out the impact to net income of any components that the company has labeled as discontinued. And we'll get to that definition in a second. But basically, all we're doing is separating the fact that we'll have one aspect of the business that will continue to operate, and then there's the other aspect of the business that will cease to operate. And that's because the company has said, okay, here's a component. We have a strategic shift in place. We're going to try to sell it or divest it. It's not going to be part of the business going forward. So we want to separate that so that when financial statement readers look at the income statement, they understand what income from continuing operations will be and what income from discontinued operations will be. Because if they only looked at net income, well, that would include income from a business component that we are trying to sell or divest. So there are a few key terms that we need to understand for discontinued operations. The first one is that it must be a component. We're not talking about a small piece of equipment. We're talking about a large identifiable piece of a business. Now, under US GAAP, a component can be any of the following. It can be an operating segment, a reportable segment, a reporting unit, a subsidiary, or a group of assets. Right? So something quite large. It's significant for the business. It will strategically shift how we look at the business as a whole. And that's one of the other key requirements. It must be a strategic shift, right? So this sounds very similar to a component, but basically it's a major line of business is going to be sold, right? So the business will fundamentally change. We may have investments in other organizations, like through the equity method. If we sell that, it's going to significantly shift our strategy, or it could be related to geographical areas, meaning we're no longer going to sell in this area because we're selling off this reporting unit or this subsidiary, right? So the exam will often make sure that you understand that it has to be a component and there must be a strategic shift in order for the company to account for this sale as a discontinued operation. If neither one of those exists, then it's not going to be considered a discontinued operation. So assuming that the company has a component, it represents a strategic shift, and they go, okay, we're going to divest of this. Well, as soon as they classify that component as held for sale, then the US GAAP rules related to discontinued operations become applicable, right? And often when we talk about selling a business or divesting a business, it's unlikely that it's going to be gone next month, right? So often these sales can take multiple periods, if not years. So it's important to understand, and we'll go through an example that illustrates how to account for the discontinued operation when it impacts multiple years. Now, one thing, like I just mentioned, is that it must be classified as held for sale, and there's a few requirements, right? So as we can see, it basically means that this business, it can be sold immediately and used by the buyer as soon as they receive it. There actually has to be a plan in place to sell this component. It can't just be like, oh, maybe we should sell it. We don't have a plan, but let's sell it, right? There actually needs to be a plan. They need to actively locate a buyer. Now, usually they'll hire an investment bank to help them find buyers, but there must be some effort to try to locate a buyer. It says they could actively marketing its plan to sell. That's a little subjective, right? Because often you're not going to see a large business for sale on Facebook or Instagram, right? But again, if they hire an investment bank to sell this business, that should do its job in terms of actively marketing this component as being for sale, right? And then there also needs to be some likely chance that it can sell. If it's a piece of crap asset or business that nobody wants, it might sit there for years, and at some point, right, it just becomes unrealistic to actually assume it will be sold. So if it's probable or likely that this sale occurs, then all of these things mean, okay, we can classify this component as held for sale. And that's going to be very important, and I'll explain why. But overall, for the exam, they really won't make you determine whether it actually meets these requirements. This is just more helpful information to understand that there actually has to be a plan to sell this. There has to be a probable plan that this can actually be sold, right? So when you think of held for sale, think of, okay, it's go time, let's sell this discontinued component. So now that we have a basic understanding of what discontinued operations means and how it's shown in the income statement, well, we then need to figure out, okay, what are some steps we can perform for the actual multiple choice questions or simulations we could see on this topic, right? So here's our mental map. And the key thing to understand is that these are steps to perform for each year. Remember, I mentioned that it can often take multiple years for a company to actually sell it once it's been classified as held for sale. So in the period it's classified as held for sale, these steps would be applicable. And if another year it's still not sold, well, then they would actually need to perform these steps again in the year that it's sold. So let's go through them and make sure we understand what it means. So when a company actually goes ahead and says, okay, let's go ahead and sell this thing, it's classified as held for sale, normally the first thing that we would need to do is check for impairment. Right, so the company would have the net book value or carrying value of this component on their balance sheet. That's just going to be basically the net assets, right? Assets minus liabilities. And we need to compare that to the fair value less cost to sell to determine if there's any impairment. Because if there is, meaning the fair value is actually lower than the net book value, we need to record that impairment loss in the period incurred. So that's one thing to check for, especially in the year that it's classified as held for sale. Now, that basically means we just write down the net book value that's currently on the balance sheet to fair value so that we can actually compare that to the proceeds from the sale in the year that it's sold. Now in step 2, this is where we're going to calculate the gain or loss on the disposed division or component, right? And this may not be applicable if the division or component hasn't actually been disposed of in this year. So if it hasn't been sold, then we would skip this and move to step 3. But if it has been sold, the calculation is pretty simple, right? It's just proceeds from the sale, and then we subtract that net book value or the carrying value. And remember, this has been adjusted for any impairment from step 1. So that becomes basically our new carrying value or net book value on the balance sheet. And the calculation is simple. If the proceeds from sale is higher, well, we have a gain on disposal. If the proceeds from sale is less than the net book value as of the latest reporting date, then we would have a loss on disposal. So that's step 1 and step 2. Those may not be applicable for each year, so we're going to have to consider that depending on the year that the question's asking about. Step 3 is very important. This is where we need to take the total impact for each year of all applicable items. So the things to consider would be the gain or loss on disposal if it's been sold. We also need to include any operating profit or loss, right? Once it's been classified as held for sale, we're going to remove any operating profit or loss that company is still incurring. Remember, we haven't sold it yet, so presumably it's still operating. So that needs to be included, and then if there was an impairment loss, we would factor that in as well. So in the example we're going to go through, we're going to show you how basically over 2 years, right, some items are applicable and some aren't, and we're going to calculate the total impact for each year. And then step 4, this is the one thing we can't forget. Remember, the government always wants their share, right? So we need to take everything net of tax. It's below income from continuing operations, right? So discontinued operations any gain or loss needs to be presented net of tax in the income statement. So don't forget the government wants their share. Now that we have a good understanding of the key terms as well as the steps or mental map to solve discontinued operation type of questions, well, let's go through an example to confirm and really start to apply this knowledge. All right, so in our example, it says that Global Corp, they operate several manufacturing divisions in North America. Now, on August 31st, year 5, the board of directors determined the aircraft division would be divested, which means they're going to sell it, and they classified the division as held for sale. Remember, that is the key turning point to when discontinued operations under US GAAP, the rules become applicable. And we're going to assume that they meet all the requirements to be classifying the aircraft division as held for sale. Now it says on August 31st, year 5, it was determined the book value of the division was $450,000, which was higher than the fair value less cost to sell of $400,000. And then in addition, during year 5, the division incurred an operating loss of $75,000, right? So basically the division, it doesn't say was sold in year 5, but we're going to have to factor in, is there any impairment as well as that operating loss again for year 5. So moving on to year 6, guess what? Global Corp, they found a buyer and they actually sold the aircraft division for $440,000. So this is the year that we're either going to have a gain or loss on disposal since they've actually divested or sold the aircraft division. Now it says they also had an operating loss of $10,000 for this division during year 6. And then we need to assume a tax rate of 30%. And basically all we need to do is figure out, okay, what impact does the discontinued operation have on the year 5 and year 6 income statement for Global Corp? Meaning, okay, what would be the net impact from this discontinued operations, right? And remember, we have to factor in the taxes. So let's go through and do year 5 first and then year 6 after that. So starting with year 5, right? Remember on August 31st, year 5, they classified this as held for sale. So remember our mental map, the first thing we do is check, okay, is there any impairment? So all we would do is take the fair value less cost to sell, which was $400,000, subtract the book value, which was $450,000, right? And that's just basically total assets minus total liabilities. That's everything that's going to be transferring to the buyer. And there is an impairment loss here of $50,000. So that's going to be recorded in year 5. Now, was it disposed? This is step 2. No, right? So no disposal in year 5, so we can skip step 2. Now, steps 3 and 4, this is where we combine basically all the items that impact the discontinued operation and then take it net of tax. All right, so we have the impairment loss, that was $50,000. They also had an operating loss of $75,000. So when we combine that, that's a total loss before tax of $125,000. But they will get some benefit from this, right? It's going to reduce their overall taxable income. All right, so we need to take 1 minus the tax rate, which is 70%, multiply that by $125,000. That means the loss on discontinued operations net of tax is going to be $87,500, right? So that's what would be reported in the year 5 income statement for this discontinued operation. Now in year 6, this is when the division is actually divested. So for step 1, right, impairment, well, we don't see anything about there being a new fair value less cost to sell, so we'll assume it's the same. And they actually had proceeds from sale of $440,000, right? So that is the calculation we need to do. So proceeds from sale are $440,000. That adjusted net book value after impairment, which would have been at December 31st, year 5, well, that's now $400,000, right? It's not the $450,000 we had back in August. It's been adjusted for impairment. The gain on disposal would be $40,000, right? So they actually disposed of it for a gain. Now, steps 3 and 4, this is where we factor in, okay, did we have an operating loss? Yes, we did. So we have that gain on disposal of $40,000. It's being reduced by an operating loss of $10,000. That means the net gain before any tax impact is $30,000. Do the same calculation, 1 minus the tax rate, that's 70%, right? So when we multiply 30,000 times 70%, that means the gain on discontinued operations net of tax is $21,000. Again, that's what would be reported as part of discontinued operations in Global Corp's year 6 income statement. So this was a great example because we had to factor in both impairment losses, gain or loss on disposal, as well as operating losses, or it could have been operating profits. And we saw how this sale or divestiture spanned over 2 years, right? We had year 5 is when it was classified as held for sale. Year 6, it was actually sold. And the impact to each year was different, but we nailed it because we had our mental map. We thought through logically, okay, what aspects do we need to factor in? How does it impact each year? And that's exactly what you're going to need to do for a multiple choice question and a simulation. So this is a great example. The CPA exam for FAR may or may not test to this level, but now you have a solid understanding of each of these pieces. The most important thing is to understand how it fits into the income statement. And remember, going back to that first visual we saw, it's after income from continuing operations, right? Then we add in any net gain or loss, right? Net of taxes for discontinued operations. And that's how we get to net income. So this is pretty common for large public companies that have operations all over the world. They're always going to be either buying or selling components. And so that's where discontinued operations becomes something that is important to understand and how it fits into the income statement.